All right, everybody, welcome back to the interview show with Patty Goodspeed that we do every Thursday. I am so excited to have Patty back here joining us today. And I'm also very excited to talk about the topics we're going to talk about today. Um, I really appreciate everybody's comments and support. I've been getting a lot of direct messages. I don't know if you've been receiving any feedback on this, Patty, but I've been getting some really positive feedback. So I'm really grateful to make an impact and give back to the people in the community and present this information in a way that's digestible and much more entertaining than the traditional way of doing it. Like, not to throw anybody under the bus, but sometimes it can be a little hard to understand what's really going on and kind of archaic and just kind of chaotic in a sense of what really is happening. So I'm really excited to break it down every week with somebody who, if you don't know her, she is getting extremely popular and really getting her name out there and really making an impact in the community with people and engaging with clients, customers, and just so many people. And so I'm so appreciative to have Patty Goodspeed on the show. How are you,
Well,
Patty?
you. I'm really good. Thank you so much for such a sweet introduction. I've been doing this for 20 years, so I love it. I'm passionate about it. I'm obsessed with it. And I think we have a very unique opportunity right now to just be a little bit louder than we were, so
Right.
that people feel a calm in the middle of the storm as we get through this.
Yeah, I mean, everybody needs a guide and a leader as they go through this. And I mean, it's really tough, just like anything in life. If you do it all by yourself, it's way harder. So hopefully we can be, a beacon of light for people to help with their transactions and to help with their financial goals.
Yeah.
Awesome. So with that being said, let's go ahead and start. First of all, I was on a webinar this morning that you were on, hosted by you and Kalani Blackwell. Shout out to Kalani Blackwell, who did an amazing job on that. And I was blown away at some of the things you were saying. So maybe we could just kind of recap it a little bit, or your top three takeaways from that webinar that you really want people to know.
Sure. So, gosh, where do I start? I do host a weekly webinar. It was born from this idea of, we call it the truth behind the headlines, because I was reading the headlines and I'm looking at the local stats, and there always seems to be such a difference, right? Like there always feels like
Mhm.
there's this gloom and doom attitude in the news. And it was kind of even sparked by this one report that, for example, I would say, I think it was 2016 or 2019. I can't remember off the top of my head, but Grant Cardone was interviewed, and Grant Cardone said that you shouldn't buy a house unless you are a multimillionaire, right? A
Mhm.
primary residence, unless you're a multimillionaire. And then later on, earlier this year, there was a headline that says, he's Grant Cardone is again talking people out of renting, out of owning and into renting, simply because
Right.
his viewpoint is that you shouldn't be owning the property, because at the end of the day, if you put $5,000 into it, at the end of 30 years you've only really made 2% return on your initial investment, versus having freeing up capital to do other things. And the thing is, where we thought was important was that you have to consider the source. When you have someone whose job is to go and say, instead of you putting $5,000 into your house and getting a 1 to 2% return over 30 years, I want you to put $5,000 into my fund, because if you put it into my fund, I can guarantee you 6% over the next 5 to 7 years, and it's a
Right.
more stable investment, and you can still be a real estate owner. Right. So
Right.
we always have to consider the source. You have to understand. I tell my daughters this all the time. Everything you see on Instagram is an advertisement. So let's be careful about what these headlines are saying and what direction they're trying to head us in. And let's just do what I think is the most important thing in every decision, is to cut through the emotion with the facts. So we try to talk about the facts. Right now, we have an inventory problem. So we still have an inventory problem. It's stated that nationwide we have 3.2%, 3.2 months worth of inventory in our markets, and I would venture to say that even in your market, it could be under 2%. So
Yeah.
if you take a look at what you have for inventory, you see that it's not just the buyers that are on the sidelines because of higher interest rates, but you have sellers that are still reluctant to go on the market because they think that there's less demand and they're worried that they're not going to get top dollar. Other
Mhm.
statistics that we talked about, these are nationwide statistics from places like NAR. So you have 29% of the transactions that are taking place right now are with first-time home buyers. 22% of them are with cash buyers. 15% are investors. 2% of them are with people that are facing foreclosure and short sales. So 70% of homes that are listed on the market are selling in less than 30 days, and the average days on market across the nation is 19. You know this, just like I know this. In our markets, we are still seeing properties that are going on the market, selling within 2 weeks above the list price. We
Yep.
are seeing homes sell above the list price. 5% of homes are sold above the list price. So the idea of the webinar is to help the real estate community have the right talking points with facts. When you're faced with a client that has a heavy amount of hesitation to list or buy, what can we share with them that's going to help them? Because I believe strongly that if someone picks up the phone to talk to you today in this climate in regards to listing or buying, then they're seriously interested in either of those two things, but they're worried and they're fearful, and it's our job to present the stats. Another thing that we talked about is how do you hedge against going into 2023, which what could be a global recession, which could drive prices of homes down anywhere between 5 to 15%, right? Those are the projections, the average projections. So how do we do that? Well, if you're talking to a buyer who's really, really sincerely worried of the short-term ramifications of buying in a time like this, then what we talk about is look at the homes that are not selling under 30 days. Look at the
Mhm.
listings that are on the market for more than 19 to 20 days. And why don't you offer 8% below the list price so that if you get into contract using that strategy, you've now hedged against what you think can shift in the 2023 real estate market in the event that the economy doesn't improve. So if
Right.
2023 is going to be the worst of it, we know that we're going to be recovering until 2026. So that the downturn actually always lasts significantly less than the runs that we have in the right direction. So we also know that real estate is a long-term purchase. It's not like it's something that you buy that you try on like at Nordstrom's and you go return it, right? It's something that
Right.
you are buying to keep. So if you're looking at the long term, then that's where this really corny phrase has become popular, which is you marry the house and you date the rate. So what are we talking about? If you're out there shopping and you're looking at properties and you're saying, gosh, the interest rate is making my payment too high, one of the solutions that we've seen quickly gain traction and get popular is the buy down. So
Mhm.
let's spend money buying down the interest rate. Let's take a 3-2-1 buy down. Let's do a 2-1 buy down. Well, let's talk about what that really means. What it
Sure.
means is that you have successfully convinced a seller to give us a portion of their proceeds to transfer to the buyer so that they can use towards the cost of buying down the interest rate. So
Mhm.
I have to look up the exact statistic from this, but I would say that more than 70% of people who have a mortgage refinance within 7 years. Okay. That might be inflated. I just made that up, but it's a big
Mhm.
number. So
Right.
if we have a significant percentage of mortgage holders that are buying a house with a mortgage and refinancing within 7 years, the average benefit of a rate buy down is not seen until after that 7-year mark, right? So if you
Right.
take $25,000 that the seller is happy to give you to get their house off sold, and you apply that towards a rate buy down, on average in your market with the sales price, you're going to see a $694 savings per month if you use the 3-2-1 or the 2-1 buy down. You're
Mhm.
taking the credit and you're applying it towards the payment over 2 to 3 years. So let's talk about what that actually means. If you took $25,000 from the seller and you did not buy down the interest rate, and you just applied it towards your closing costs and you saved $25,000 out of pocket, over the next 12 to 18 months, which is what I project people are going to refinance within, and that's very conservative. I do truly believe it's sooner than that, but I like to speak conservatively. So if you
Mhm.
refinance within the next 18 months,
Mhm.
over 18 months, if you pocketed the $25,000 and put it in a separate checking account and you applied the savings yourself, you're going to
Mhm.
save an average of $1,300 a month. Which one is better? Keeping the money in your own pocket? Because here's what happens. If you do refinance in 6, 8, or 12 months, you have just forfeited the benefit of taking the money from the seller and applying it specifically to a rate buy down. So we
Mm.
have to be in position to properly
Yeah.
educate people. If I constantly talk about interest rate, then that's what my client is going to be worried about, the interest rate.
Right.
The
Right.
interest rate is not as important as what you're trying to pay monthly, because the only reason people are on the sidelines regarding sidelines to purchase is because of the higher interest rate environment, increasing the cost to purchase. So
Right.
in your market and many of the markets that we serve in the Bay Area, this is a very honest and real conversation. The rate buy down can make the difference in some people's ability to qualify. That's a little bit of a different story. If the debt to
Right.
income ratio is 51% and you need to get it to 48%, qualifying is different. But when we're talking about strictly savings, then we need to teach people a little bit a better approach than taking all that money and applying it to a rate buy down on an interest rate that they definitely are going to refinance within 12 to 18 months. Because the cost of buying down an interest rate in your market with the average sales price of, let's say, 1 million or 1.2 million, the average cost of that buy down is going to be significantly it's going to be insignificant on the payment. The buy down cost is significant, but the difference in the payment is insignificant for the
Right.
long run. So that means you have to have the cost benefit analysis. Is you take the savings, you take the amount that it costs you, divide it by the savings, and then you have this monthly amount that you're saving, and then you get to determine how long before you break even. That break even number is anywhere between 6 to 10 years. That means you have
Mhm.
to sit in that mortgage for that long. Well, if you only bought the rate down to 6% and the mortgage rates drop to 5.5 or 5.25 by next spring, you're going to
Mhm.
refinance.
Right.
So we have to educate people on the numbers and not just jump on every hype train that comes our way. So that
Right.
was kind of the gist of what we were talking about. And of course, talking about other programs. And I'll let you get into your questions. I talk a
No,
lot.
no, 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 I love that. I actually wanna just dive a little bit deeper into that, or just slow it down for people that are like, "Yeah, I'm interested in rate buy down. I have a rate buy down. Can you say that again?" Because my goal for this is to get people to be able to grow their money, right? And to be able to know, have as much knowledge as possible when they are in that transaction, or if they have completed a transaction and they're watching this, then they're like, okay, this is the way how I'm going to structure my savings, and and this makes sense for me. So I just want you just to say that briefly again, as far as like if you are to get a rate buy down, and let's say that the interest go is like, say your rate buy down 6% and interest rates are like 5%, or mortgage rates are like 5%, or whatever it is. What is the strategy there as far as savings versus the rate buy down?
Mhm.
Just to reiterate that, because I think that's very important.
An interest rate buy down is almost rarely worth it. It gets this. It's almost like the whole idea of FOMO, right? Many people, when you're buying a house, you start talking to everyone about house buying, and you think that Jan and Sally got their interest rate at 2.75%, and you have to also. So you're just going to do everything it takes to get the same rate, so you can say, "Oh yeah, mine's 2.75." We really got to get out of this mindset. I've done this again for 20 years and at a high level of transactions. Every single transaction is different. Everything. You could be buying a house in the same neighborhood, and if I examine 100 different loan processes for the 100 people in that neighborhood, it was different for each one of them. They all could have excellent credit. They all could even have 20% down, but the entire process is different for everyone. Everyone's personal finances are different. So getting out of the mindset of the hype of saying, what's my interest rate? I need the lowest interest rate, and understanding and dive into, and this will be good research for me to do for next time, is how often people refinance, right? In a
Mhm.
great interest rate environment. When you have refi booms, 89% of refinance applications completely went out the door in 2022. No one
Wow.
is refinancing unless they absolutely have to. And so 89% of refinance applications are gone this year. Why? Because the rates are up and everyone has a low rate and there's no incentive to refinance, right?
Right.
So what happens when rates drop after a high interest rate and a period of higher interest rates? another refinance boom. People who have got into higher interest rates over the last few months and over the next few months are going to want to refinance as soon as the news hits that rates drop. Okay. So what does that mean? That means that if you spent $25,000 to lower your 30-year fixed rate from, let's say, 5.875 to 5.25%, and
Mhm.
you have a $1 million loan, getting that interest rate, if interest rates were to drop to 4.5 or 4.25% to 4.75% by spring or summer of next year, you're going to want to refinance, because a 0.5%, 50 basis point reduction on a $1 million loan is very significant. And for people that have loans that might be watching this, that their loan amounts are lower, anywhere, let's say between 300,000 and 700,000, it makes more sense to refinance usually when you have a full percentage going down on the interest rate, right?
Right.
So, well, if you're spending $25,000 on the rate buy down and you're getting a loan that's fixed for 7 years or 30 years, and you plan that, we're telling you from a professional opinion that you're probably going to refinance within 12 to 18 months instead of the 84-month period that you bought down the rate for. If you refinance in 12 months, not only does the term of your loan start over, but all of the closing costs that you paid for that rate buy down goes out the door.
Hmm.
So that's the problem. You're
Wow.
spending a large amount of money to lower the interest
Hmm.
rate to
Yeah.
get, unless you keeping that loan at 5.5% or 6.25% or 6.875%, or for many people 7%,
Mhm.
unless you're keeping that loan for the next 7, 10, 30 years, and you're not going to touch it when rates drop in the next 12 to 18 months,
Mhm.
you're wasting the money. So
Wow.
what I'm suggesting as an alternative is to absolutely get the money from the seller. Don't
Mhm.
not negotiate. If you don't need the money, lower the price. Getting in
Mm.
at a lower price point is a smart thing to do when you're going into a market where prices could potentially drop by anywhere between 5 to 15%, which I think will be closer to 5% or 8% in our markets. But
Okay.
if you know that the property value is going to go down, why
Mhm.
inflate the price for a credit? Many people think that it's an awesome strategy to offer the seller a higher purchase price to get money back towards closing costs.
Mhm.
That's the same as financing the closing costs. So
Right.
if you don't need the strategy, the alternative would be to ask for a lower price. So if you're negotiating the credit, why am I saying that it's better utilized against the closing costs? Because if you now were going to use the $25,000 to buy down the rate, but you still had to pay $20,000 in closing costs, including taxes and insurance, then what happens is, if you pocketed that $25,000, let's look, I believe I did the math on the webinar. So $25,000 that I kept in a separate savings account that I saved because the seller paid for my closing costs and I didn't have to inflate the purchase price for it. Then what happens is, if I divide that $25,000 by 18 months, my monthly savings would come out to about $1,300. So if I took the seller's money and I put it in my checking account, or you know what I'm saying, you're balancing that out. You use the seller credit to pay for the closing costs. So now you have $25,000 more than you anticipated at the close of escrow left in your account. And you put that money in a separate checking account and you divide it by 18 months. You just helped yourself lower your monthly payment by $1,300. You did it for yourself
Mm.
instead of taking the money from the seller that you could potentially give up if you refinance within 2 years.
Right.
So
Makes
if you're
sense.
taking, yeah, you see what I'm saying? So,
Yeah.
and I try to help people understand the math behind it. This is not a universal law. This is why real estate is very specific to each transaction. We want to properly advise people that are purchasing homes between $800 to $3 million with
Mhm.
10, 15, or 20% down at a time like this.
Right.
Someone will say to you, hey, the value of my stock went down. I don't want to sell stocks. So I'm not going to buy right now. No problem. I think that's wise. You don't actually make or lose money until you sell the stock. You still
Right.
own the asset, right? You got to sometimes write it out.
Right.
So, but if you could take a loan against your 401k, and if you could borrow, if you could use the money that you have in savings, let's find a way that you can qualify with less down.
Right.
Because why would you want to do that? Now, we're not going to be the agents in the business that go out and say now's the best time to buy. We're not going to do that. What we're going to say is if it works for you, the trade-off for the higher interest rate environment is we can target homes that have sat on the market a little bit longer, and we can negotiate a strong deal, get some money back or get a price reduction, and that's going to help you get in position for when things change and demand picks back up. Because what I can
Right.
tell you, based on the national statistics, is that 70% of homes are still selling in under 30 days. The average days on the market is 19, and we are still seeing a lot of activity in the real estate market. And as soon as those inflation numbers go down, rates will also go down theoretically, and we're going to see demand pick up,
Right.
Lord willing. So you see what I mean? Those are the talking points that we want to make sure that we are reiterating. But the proper use of the money that is available to the buyer at closing is, I think, mission critical for us to get that
Right.
right instead of just jumping on something that's popular.
Absolutely. That's really great information, and that's something that, I think we all need to reconsider and think about and talk with a lender about because, at the end of the day, it's about getting it done, but it's also about making sure that the clients are in the best financial position and we're looking out for their best interests. And I think that's something that we really need to start focusing on because I know in my market in particular, there are a ton of listings right now that are offering buy downs, and maybe it doesn't make sense. So it's something to revisit. Um, so I
Well,
really
they're doing it
appreciate
to generate
that perspective.
traffic, right? So if they're
Yeah,
doing it to generate, like if we're going to generate
right,
traffic to the listing as the
right,
buyer's agent, go get the money, but let's talk to them about how they can use the money.
exactly, exactly. So that's really great, and that's something that I hope everybody takes away from this video that watches this. So let's continue down this buy down trend here that I guess we can call it a trend. So as far as adjustable rate mortgages go, is it a good idea to do a buy down with an adjustable rate mortgage? Because I have certain clients that are thinking that they want to buy using adjustable rate mortgages. And is it good for them to go use an adjustable rate mortgage with a buy down, basically saying they're going to buy down their rate, to get the lower rate. So when they do refinance, they refinance at that rate. But with the adjustable mortgage, it could go up, it could go down, depending on what the years of the arm are. Right? It could be 3 years, 5 years, 7 years. So what are your thoughts on that?
So let's go back a little bit. Adjustable rate mortgages got a bad rap from the 2007 and 2008 housing crisis because of a simple product that was out there. A couple things. People were doing the terms for short 2-year terms. Also, there was a
Mhm.
product called, it was a negative amortization loan. So what you saw was that someone was getting an adjustable rate mortgage with a negative amortization feature, which meant that they were only paying their monthly payment was only a portion of the interest. And the interest that was not being paid in the required payment was accumulating, and the balance of the loan would grow. And the only reason this would have been effective would be because they assumed that the market would continue to grow.
Mm.
So as a result, people started, their balances went up. When the market crashed, the equity flatlined because of the surplus of inventory. And that's why you saw a lot of short sales and a lot of foreclosures because
Mhm.
it made no sense to pay on a $650,000 mortgage balance where you had the balance growing and the property value went down to 520.
Right.
So adjustable rate mortgages got a bad rap because of that particular product, because an adjustable rate mortgage, is designed to be fixed, like you said, for 3, 5, 7, or 10 years.
Mhm.
And when you have a loan, it's fixed for that period of time. At the end of the fixed rate period, in most circumstances, the loan will recalculate, will recalculate based on the new principal balance. So if you
Mm.
had a rate of 5.25% and it's fixed for 10 years, after the 10 years, it will adjust twice a year, once or
Mhm.
twice a year, depending on the product, and it's going to adjust up to 2%. So it can only go up or down by 2%. on average. And then what happens is the loan gets recalculated, the payment gets recalculated based on the lower balance. It actually is not very risky at all. And that's why the adjustable rate mortgage itself is an excellent tool to use, especially considering what we talked about earlier, where most people refinance within 7 years.
Mhm.
So, for one reason or another. Now,
Mhm.
what you specifically asked was about the buy down relative to an ARM. So I want to share something that everyone needs to, I think, understand. I should have said this on the webinar as well, is that it's impossible to get a no cost loan right now. So I always tell people that if you imagine interest rates on a scale of 1 to 10, so you have 1 being the lowest and it comes with the highest cost, 10 being the highest rate that comes with the highest credit, 5 being in the middle. So there's no cost to 5%, there's no credit from the bank.
Mhm.
That scale moves up and down. So it's the cost of the rate that changes, not the rate. The rate doesn't just disappear from the rate sheet. The cost of those interest rates fluctuates and goes up and down. So you could get a 2.875 loan fixed for 30 years, a year and a half ago, 2.5, 2.875 fixed for 30 years and pay no lender fees and no points. You just don't have that anymore. You can't take even if you're buying a if you have a 680 credit score and you're buying a $700,000 home in the Bay Area and you're putting 5% down on that property, or even 3.5% down on that property, and your interest rate is in the mid to high 6% range, the average 30-year fix is 7.37% as of this morning. You are paying a cost for that rate. So if you're trying to get 6.5 and the average is 7.375, on average, people are paying 1% of the loan amount in fees in addition to standard processing and underwriting fees. So the cost of financing is higher even if you're buying. So no matter what product you're getting, you're paying some sort of fees for the rate right now, most of the time.
Mhm.
So if you're getting an adjustable rate mortgage again, and you can get 5.375 or 5.875 on a 7 or a 10-year fixed product, and in that, even that interest rate might cost you 0.5% or 1%, half a point or 1 point. So that's not what we're necessarily referring to when we're talking about a buy down. There's a cost to the rate, and then for whatever rate you want. And then if you want to continue to buy it down from whatever the average market price is, then that's when you're spending too much excess money on something that won't benefit you for a longer term.
Right.
I have people that will opt for the higher interest rate to lower the amount due at closing, just simply because they don't want to even pay whatever the cost is to get that lowered rate. So and we're talking again for conventional loans, or not jumbo, but conventional loans for your buyers that have loan amounts between 640 and 647 and 970,800 in your market, for example. So between 647 and 970,800, which is the current limit for the higher balance loans, you have in that category, if they're not qualified for jumbo financing, they have to put less than 10% down or whatever the deal is, then they are going to have an average interest rate with no cost would be around 7.25 right now,
Hmm.
between 6.875 and 7.25. So yeah, that's where you're at. So there's going to be fees associated with the rate, no matter what product you have, no matter what you want to lock. What we're talking about is taking the large lump sum of money from the seller and applying 100% of that towards the rate buy down is not the right choice, in my humble opinion.
Awesome. Okay. Awesome. So let's shift gears a little bit. Let's talk about bank statement loans. What are those? I'd never heard of this before, but I'd love for you
Oh,
to
really?
elaborate. Yeah.
Well, I'm excited that someone like you just hasn't heard of them before, because this is
Yeah.
exactly why I'm talking about them so much. So let's say the idea is that I can help you increase your business by just simply talking about a product that makes sense for so many of the business owners in the communities that we serve. Um, so the example that I gave that's the most fresh on my mind is that I have a client right now in escrow for 1.3 million. They have a business that has an average deposit of about $20,000 a day. The net income on their tax returns is less than $50,000 a year. So what happens is if you come to buy a $1.3 million home, $50,000 a year won't cut it. So instead of using the tax returns to calculate income, we're able to take an average of 85% of the gross deposits into the business bank account over a
Hmm.
12-month period. So the 12 most recent business bank statements would reveal that this client is actually making, you know, $300,000 a month. So qualifying for 1.3 million is easy, no brainer. It's easy, right? Even I have another example of someone who claims has a negative $20,000 of income on their tax returns, but according to the average income used on the 12 most recent business bank statements, that calculation actually comes out to $72,000 a month. So you just went from not qualifying for anything to being now qualified for a $3 million purchase or a $1.5 million purchase or even an $800,000 purchase. Or we're
Wow.
doing run in Atlanta right now with like a $400,000 purchase price, right? So this isn't a powerful product, and here's why. So the number one objection that you're going to receive for this is the interest rate. So again, if you can get a 6.875 interest rate on a 30-year fix for a conventional loan, and for the bank statement product, this is called a non-qualified mortgage. That means it's not a standard product. It's outside of the normal agency products, and your interest rate is going to be higher. That's the bottom line. So
Hmm.
the difference between the interest that you pay at 6.875 and the interest that you pay at, let's say, 8% is roughly going to be about $575 a month. Grab my calculator. So at $575, so what you see on average, and as you saw a couple testimonies on the on a couple testimonies on our webinar, is that we're seeing a lot of lenders make TikToks and videos and saying, hey, if you're self-employed and you're not claiming enough income on your tax returns, you need to change that. You need to go amend your taxes, go claim more money, take off, you have to pay more to the IRS to qualify to buy a house. I don't think that any loan officer, unless they are a licensed CPA, is qualified to make that recommendation to anyone, right? So we're not
Hmm.
going to recommend that you amend your tax returns or write off or put down more income. What I'm going to ask you to do is to consider the bank statement program. Because for the same 15 to 20% down that you're going to put, here's what's going to happen. If I ask you to go and go from the negative 20,000 to $250,000, negative 50,000 to 250,000. Let's say at worst case, best case, excuse me, with federal and state taxes. I'm not a tax professional. This is an estimate. You're going to pay approximately 38% of that to the IRS. That's $95,000. That's a $95,000 check that you would have to write to the IRS if you completely changed your tax strategy that was approved by your licensed CPA. I'm not a CPA. So that 95,000, the difference between the interest you paid at 6.875 versus 8% is $6,900 a year. So you would rather write a check to the IRS for $95,000 by taking that loan officer's advice so that you can have a higher net income, or would you rather pay an extra $7,000 a year in interest when the interest has a benefit to you with some limitations with the current tax laws against your tax returns and
Yeah.
against your
Obviously, the
Mhm.
second one. The second one.
Right.
Yeah.
Exactly. So there's not a single entrepreneur in their right mind that would amend their taxes to take away some of the actual legitimate business expenses that they have to increase their net income, write a check to the IRS just to go put 20% down on a house. That makes
Right.
no sense whatsoever. So
Right.
we want to make sure that we really take that into consideration when we're talking. So if you talk to 3 self-employed people a week and they thought that they weren't qualified because they didn't have enough income on their tax returns, you can take one of those clients. You're just going to increase your business by 20% with this product alone.
Mm, that's awesome. I love that. I never heard of that, but that seems like a game changer for me because especially in this market we're in, why would you want to add extra income to your taxes, pay a bigger check so you can put down a bigger down payment, and then you're paying more in the long run anyways because of, where we're at in the cycle of rates, right? As
Mhm.
opposed to putting that money back into the business, paying a higher interest on it, but also just paying what was it, monthly? So it's like
6,900 a year, 575,
yeah,
575 a month. the difference. And
Yeah,
I would do that exact calculation for anyone in real time
right,
to make sure they're making a sound decision.
right.
Because it doesn't matter. The numbers are always going to be relative, but that difference is going to be you're talking about a minimum of 3 times more in a check that you would
Mhm,
write to the IRS versus higher interest. This is my message to the universe. Let's stop focusing on the interest rate and let's focus on how we can use the tools available to us in the current market to keep more money in our pockets.
right,
That's what we want.
exactly,
We want more money in our pockets
exactly.
because you got to be more liquid to survive a recession.
Yeah, exactly. And I mean, you got to have education too, right? That's part of this. That's why we're doing this. I want to educate people and give people the best information and knowledge so that they can be knowledgeable because this isn't readily available information. You really have to go seek it out and find it. And here we are just giving it to you just for nothing. And that's really what I want to do. I just want people to be educated and have a different perspective than
Hmm.
what the traditional perspective is or what they're hearing on TV or whatnot.
Yeah.
So with that being
I
said, yeah, go
going
ahead.
viral. I was saying I'm not a
Yeah.
fan of going viral for dumb things. I want to talk about the meat and potatoes, but yes, go ahead. Sorry.
Well, I mean, that's kind of where civilization is, right? Like you go on TikTok and it's like somebody's like, I don't know, just there's a Roomba going around a room and they're just like filming it. It gets like 2 million views. Like it's like nuts. Like I just don't, it's weird. Like the viral thing to me is very weird, but let's not go down that um too far down that road right now because that's really not what we're talking about. That's a different podcast, different day. Um, so let's talk about negotiations. What are you seeing or what are you hearing? And obviously, we covered a lot with the buy downs. We covered opposing the buy downs with using that closing cost to put into a different to save to put into savings. And so what else are you hearing or recommending for people as far as negotiations go?
Well, I think to keep things realistic, we have to remember that if a house looks nice and it is well manicured and properly staged and vacant, you can't lowball that deal. It's really that simple. So we have to realize just because you're in an environment where there's less demand doesn't mean that real estate transactions have died. We are only at 23% less transactions this year than last year. If
Mhm.
you think about how unrealistic the momentum was and how the
Yeah,
energy of the real estate business was in 2021 and
right,
coming into 2022, then you
right,
understand that a 24% reduction in transactions is kind of not that detrimental, right? So we're
right.
selling this idea to people that you can go out and it's bloodshed and you can go out here and get whatever you want. And yes, you can negotiate on your terms. Yes, the trade-off for a higher interest rate environment is lower prices, but that's not going to happen for 5% of the listings that you're looking at that everyone wants. The ones that look good,
Mhm,
the ones that are clean, the ones that are vacant, and the ones that are updated. It's just not
mhm.
going to happen. So just starting with
Right.
that realistic standpoint. Then we look
Yeah.
at 70% of homes are still closing in less than 30 days. They're selling from list to off the market and closed in less than 30 days. In less than
Mhm.
30 days, still in this environment. So what does that mean? That means that if you want to negotiate on a property and you want to lowball, then you're going to have to go for the properties that are sitting on the market for 15 to 20 days with no offers. It's that simple. That's my biggest message in terms of people who I have clients that are very well qualified with millions of dollars in the bank that want to buy investment properties that are lowballing every single offer. If you think that, and they're not getting anything accepted. So if you think that the seller is going to give you a 40% discount on the list price just because interest rates are higher, you're absolutely wrong about that. So
Mhm.
have the right mindset going into the field and saying, I want to negotiate a deal. And if I want to negotiate a deal, then the inventory that I need to observe is inventory that is sat on the market for 15 days without any offers.
Right.
It's tricky. I have a client who had a deal. It was $725,000 was the original list price. They went down to 680, no offers. They went to 649, what the client originally wanted to offer. And
Right.
he got it at 649. So he waited
Yeah.
and he got it at 649. So if
Yeah.
it's sitting there, you're gonna get what you want. If it's not
Right,
sitting around, you're not getting it. Yeah. So
right,
that's my strategy for negotiations. And if you paint
yeah,
that picture for someone, it makes your job so much easier, doesn't it?
right. Yeah, absolutely, 100%. I mean, I'm actually dealing with that right now. There's a condo in Monterey. The sellers and the listing agent have said they're gonna do a price reduction. It's been a week. We haven't seen a price reduction. And and so my buyer's like, well, I'm not going to buy this property unless they reduce the price. I'm like, well, let's just offer the price at what you want and see what happens. And
Mhm.
so now he's finally coming around to that realization because it's taken some time to digest it and think about it. And it's like,
Yeah.
okay, well, the market is different. Like you're thinking you have everybody still has that 2021 mentality of these it's hard to negotiate with the sellers or it's difficult to get, and it's like it's really not. This property's been sitting on the market for over 70 days, and I research this every single week in Monterey County, where I could tell you the amount of properties that are sitting on the market for over that amount of time isn't really changing. And what's changing is the the homes that are selling faster. That's
Mhm.
what's changing. That's where we're seeing the inventory change. The houses sitting on the market aren't the same. There's probably needs some kind of maintenance. It probably needs some kind of work, and people aren't just they're not interested in it because guess what? If you price it too high, somebody's going to come in and make a competitive offer, and they're going to say, we'll give you X amount for this. Like 2 weeks ago, we saw so many things selling over list price, over asking price. And that was because the end of August, we saw rates go below 6%. And once that happened, you saw all these buyers come into the market, and all these 30-day escrows then got completed last month in the month of September. And we saw, 5 of 6 houses in Carmel sell for over asking under 10 days on market. In Monterey, 6 of 12 houses sold for under 10 days.
I
Uh,
loved when you posted
you
that. That
know,
was so good.
yeah, and so it's like really it's a correlation of where the rates are to what you see the offers at, because as the rates go up, people are like, well, now I have to figure out, do I want to put money into fixing the roof? Do I want to rip out the wall and get rid of the problem that there is possible mold damage in the house, right? Like all those things. And like and so not I'm not saying that that happens a lot. I'm just saying I know of instances where that has happened, where there could be potential mold damage in the wall. And I mean, all that stuff is really expensive to fix. Remediation is really expensive. To even get a quote and an estimate is really expensive. And so you have to remove those types of things from the psyche of the client, because they're thinking about all these things. And it's like, okay, well, you have these tools and resources to be able to help you, and I'm here to guide you the best way I possibly can to make sure that this is a seamless, smooth transaction, that you're being responsible with your money, that you're not going to get yourself into debt, you're not going to be underwater, and this is a situation that you're fully in control of. And I think if you can eliminate all those things and give the buyer that kind of responsibility, then I think that it's a really great thing, and it's a really great way to approach the market. But if you're afraid, and like something I do also is I have great relationships with listing agents. I text them, I'll call them, but I'll talk to them about the house, and then I'll ask them like, "Hey, what are you seeing about the market?" Or like, "What are your thoughts on where things are going?" And it's like it's not a conversation that takes a long time, but it means a lot, because it's like, hey, it shows that you have this common ground, and you have this shared viewpoint that's really powerful. And so
That's a great tip.
that's been really helpful. And that's just something that I have agents when I'm in the office in Monterey. They're like, how do you have such good rapport with listing agents? And I'm like, I just talk to them like they're normal people. Like I'll call and say, this is what my buyers are looking for. Here's their situation. Throw everything out on the table, and it just really puts their guard down 100%. And that's something that I've seen that's really helpful in this market. So not to go off on a tangent about that, but I just want everybody to know that that's something that I've been doing that's been working that I've seen
That's great.
in this
Yeah,
market.
I
So
think that was a great tip.
yeah, thank you. So let's we've been going for almost an hour here. We've been going for 45 minutes. So let's end with what's coming next, Patty. What do you see coming down the pipe?
So we have a lot. November is going to be filled with lots of reports. We have unemployment. We have another Fed meeting. We have another rate hike that's pending. We have lots of economic data that's going to be coming out. Another CPI report. There's a lot. November is going to be busy. Our conversations in November are going to kind of be volatile, just like they've been. We're going to
Yeah,
address the volatility, but there's a lot to expect in November.
yeah.
Um, and I'm just hoping for a little bit of a decline in that inflation number. And I'm just hoping that what we're seeing the feds do is good because we need them to be aggressive in their stance. But at the
Mhm,
same time, we're really ready for that. We're really ready for that pivot. So we'll see if that happens in November. If not, we might see it coming in December or January. And that's what we're looking for to see, an ease in the market and some interest rates improving. So November is going to be busy and filled with lots of data. So
mhm.
expect that. And again, for anyone listening, I have a free webinar. You can find the link in my Instagram bio. Everything is at Padi Goodspeed, and it's once a month. We only do it once a month, the third Thursday of every single month to kind of recap all the news and keep people on track. So
Awesome. And then just to recap, Patty, if people are watching this for the first time, they don't really know much about you, just tell us just a little bit about your background in the industry and how people can get a hold of you and where you're located.
sure. So I'm licensed in 23 states. I've been a mortgage banker for 20 years. I'm currently in Northern California, but again, I service multiple states and obviously throughout the state of California. I'm a California girl, never leaving, even though the taxes suck. Um, you can reach me at bookwithpadi.com. So Patty is with a D, Padi, but bookwithpadi.com is a great way to get on my calendar to schedule an appointment. We can even do Zoom with your clients or teams, or yeah, just anywhere. I'm easy to find me, Patty Goodspeed.
Awesome. Well, thank you so much, Patty. This has been really insightful. This has been such a treat having you on here every Thursday. This is the second one we've done. I'm really looking forward to the next few weeks, especially leading up to November. And
Yes,
as we kind of figure out, hopefully, we get a more clear economic picture, and hopefully, like you said, we get some relief and things start to U-turn. That would be a really great improvement, I think, for the stock market. I think for the bond market, the treasury market, and obviously for mortgage rates. So hopefully, all those things can align. We can get this ship righted in the right direction and keep going. But the market doesn't. The housing market doesn't look like it's. I mean, it's slowing down a little bit. Last week, we didn't see a lot of things selling. There were a lot of kind of goose eggs across the board as far as pending contingent. But I think we're starting to see a little bit more activity and starting to see it come back as far as the numbers that I could see. Obviously, we still have an inventory problem. So that's something that we obviously need to address. If you follow my market updates that I do, as well as my YouTube channel, you know that the county of Monterey has to add 32 or 132,000 houses by the year 2030. So hopefully that can help with the inventory problem, and hopefully they can balance in the middle, right? We don't get so much inventory that it just sits and then prices go down, and that's what causes. In 2008, I was looking at a statistic yesterday. There was so much inventory on the market in 2008 that there was so much demand too, but that's really what led to prices going down and to the eventual crash was there was so much inventory. And now we're not
surplus.
seeing that. We're not
Mhm.
seeing that in 2022. So just keep that in mind. This is a completely separate market and something completely different than what we saw in 2008. And we have a shortage of inventory. And like you've said many times on this channel, that's why we should not use the word market crash, because we have such a little inventory that it's going to be um, impossible for the market to crash. And knock on wood, because who knows what's going to happen. We're in unparalleled times. But as far as history teaches us, that does not create a market crash.
Perfect.
So that's
You
it.
said it.
Thanks, everyone. One more time, Patty, just go ahead and give your shout outs where people can find you and your social media again, and just plug your webinar again, just so people have the full scope and can keep up to date. And we'll end on that.
Thank you so much. Yeah, Padi Goodspeed, at Padi Goodspeed across socials, and bookwithpatty.com, Patty with a D, for any one-on-one time. And I look forward to serving you. My webinar is once a month, and maybe we can put the link in the comments.
Awesome. We can definitely do that. All right. Thanks,
Cool.
everyone. We'll see you guys later. And Patty, hang tight. We're just going to end the show. See you later. Thanks.